Good afternoon. I hope everybody's having a fantastic week. My name is Randy Sadler. I'm a principal at CIC Services. We're a captive manager in Knoxville, Tennessee. And our webinar today is Trouble Right Here in River City. Many of you probably know the play The Music Man, also TV show. And certainly the theme is apropos for where we are for middle market and small businesses in the United States. There's definitely trouble right here in River City. And what we try to do at CIC Services is share with you many unique ways that you can really introduce captive insurance to your clients. And many of you have small, mid-sized business owners that would really benefit from protecting their business with a captive. And so I'll be happy to send these slides to you, but it is a little bit different approach that you might want to use to share it. So this is the captive insurance presentation to share with your business owner clients. It's always helpful to start with really who we are, just so you know who you're on the webinar with. I'm Randy Sadler at CIC Services. We are a captive manager. I think we're really a nationally recognized captive manager that works in the small mid-market space. We really focus largely on small mid-market entrepreneurs and helping them protect their business by owning their own insurance company. And that's really the magic of a captive, is the ability to own your own insurance company. We predominantly work with the advisors to those small mid-market businesses because if you think about it, most mid-size or small companies really don't have the financial horsepower of a Fortune 500 CFO. They may have a CFO, but think of all the finance strategies that CFOs have. Very often, their CPA, their wealth manager, their property casualty insurance agent, other advisors to the business outside the business are really able to think strategically. And so in a sense, very often you become like their CFO. And so we are honored to work with you and partner with you in any way we can. So a little bit more about CIC Services, and then we'll dive into the meat of our presentation today. As a captive manager, we help businesses own their own insurance company, and that allows them to, one, establish what we call asset protected loss reserves. So those businesses or business owners are able to build up a significant amount of money that is asset protected and can protect the business, especially in the event of a claim, but it also accumulates reserves. It also enables our clients to increase their profit, or generally by millions of dollars. So they're really turning insurance into a profit center. Many of our clients are able to lower or control their insurance costs by taking some of their commercial insurance into their captive. And so that does lower their exposure. And many of you probably are aware, it is a hard market right now. Insurance costs are going up. And so we're seeing more and more businesses that are putting more and more risk in their captive. They're taking the risk on themselves versus passing it on to a third-party commercial carrier. And we'll cover that in more detail. You can also insure uninsured, underinsured risks. COVID-19 is a classic where many businesses had a loss due to COVID. Their business was closed, likely by the government of their state or municipality. And because they did not have property damage, most were unable to file business interruption claims. Their property needed to be damaged for that to happen. So, and the same would be true, for example, with if riots were outside your building. I talked to a business owner last week who has 4 locations, one of them actually in a place where there were riots last year, and they actually couldn't go to work for several weeks because of the unrest, and they lost business at that 1 out of 4 locations. Well, that was a big deal, and that's a revenue interruption that a captive could cover if your commercial insurance doesn't. And then finally, and importantly, you can benefit from insurance company tax treatment. Insurance companies are taxed differently than your actual corporate tax rates are. And so that has a lot of benefits. And so we'll talk about that as well. All right, so the theme of this webinar today is we've got trouble right here in River City, really right here in the USA with a capital T. So you're going to see a theme here with T's. 2020 was a tumultuous year, and 2021 isn't looking any better. And really, I mean, if we're really honest, as small mid-market business owners, advisors, the entire 20s decade isn't looking that good right now. So let's start with the first T. That's trillions of stimulus dollars. I mean, there's real potential for inflation, potential for a weak dollar, and it's really hard to know what that's going to do to the U.S. economy and how that's going to affect businesses. But it definitely should be a cause for concern. The next T is turmoil. The workplace. And by the way, you're going to notice a theme here. Many of the things that I'm going to put up are things that a captive could actually insure and protect the business from. So workplace violence, which is often excluded on your commercial insurance policies. So maybe something you really want to look at in a captive. Cancel culture, which really kind of goes hand in hand with reputation damage or somebody really trashing you online, and all of a sudden your market gets cut off. Business interruption. Many businesses face that due to COVID, due to riots, and very often their commercial insurance didn't cover it, where a captive likely would have. Utility outages, and this sounds like something you'd hear about in a third world country, but right here in the good old USA, we have regular utility outages in California. Texas had some massive outages during the deep freeze. Sadly, this is becoming more normal in our country. And then even loss of a key customer or a market. So turmoil is the next T. The next T is treachery. And you'll notice here, reputation damage, which can often come from somebody who's being a bad actor, lies about you, says bad things about you, and may necessitate, if you own your own insurance company, filing a claim to deal with it, whether you have to sue someone to stop them, sue a reporter who's lying about you, and then set the story straight with advertising and public relations. Cyber attack, talk about bad actors. Businesses are constantly under attack, and those risks are constantly evolving. And your commercial insurance rarely addresses the full spectrum of cyber threats. And so you may have a commercial policy for cyber. Look at it very carefully. Look at all the things it doesn't cover. For example, they rarely cover human error. Well, that's where a lot of cyber threats occur, is due to human error. So you may be vulnerable there, not even realize it as a business owner. Employment practices, often, and we live in a time when people are looking to pick a fight and sue their employer. And as an employer, you could do everything right and still get sued by a rogue employee. Lawsuit, without a doubt. And we've talked to a lot of business owners this year that have seen their, kind of petty lawsuits go up. What I mean by that is that due to the pandemic, consumers are desperate. And so slip and fall and staged accidents and attempts to, get injured or attempts to, win money in a frivolous lawsuit are up, and that costs money, and it definitely is a concern. And then a hostile employee, perhaps an employee that leaves and takes clients with them. This is a real risk. You can cover this often with a loss of key employee policy in a captive, and then obviously commercial crime in some cases. The next T is tempest. I'm sure you're familiar with the term tempest and storms. Business interruption due to natural perils, which is very common due to pandemic. Flood, wind, hail, wildfires, and drought, no doubt. A deep freeze, as we saw in Texas, excuse me. And then crop failure is another very real one. Our next T is tyranny. We're heading into an era where we're going to probably see more aggressive government agencies. We've seen this largely at a federal and state and local level, with varying degrees of lockdowns due to COVID. But the Department of Labor, the EPA, OSHA, aggressive enforcement on businesses can take a terrible cost. And it's something that business owners need to be ready for, not only from a mitigation standpoint, but from an insurance standpoint. And so you'll see here it says administrative actions. This is an insurance coverage that's often written through captives that protects against or pays for the cost incurred dealing with a regulator who's increasing your cost and bringing fines on your business. The next is legislative regulatory changes. So it's possible via a captive to insure for the cost of new laws or new regulations that actually increase your cost of doing business or cut off your revenue. So very difficult to insure that in a commercial market, but it can be insured in your captive. Terrorism, the next T, well, that can include international terrorism. It can also include, domestic terrorism. We heard much in the news about peaceful protests, but there was an awful lot of property damaged for these peaceful protests. So I think as a business owner, as an advisor to business owners, it's very real that a mob or riot could damage your business or almost make it impossible to get to work or for your clients to come to your workplace. So that's very real. And then so that drives loss of access to property or markets. Our next T is trade tension. So think about supply chain risk, think about tariffs, think about piracy. We continue to have international tension, although it may improve, but typically it just shifts from one place to another. And then importantly, and not a surprise, taxes. Taxes are expected to increase on businesses. They're expected to increase on business owners, and that's going to have a very real impact. I mean, it strips retained earnings out of businesses, leaving them more vulnerable. Very often describe it as, businesses can be left hollowed out by taxes. And taxes often push capital or businesses or jobs offshore. And so, increasing taxes tend to have that effect, and that's going to have effects on supply chains. It's going to have effects on the ability to get labor. A wide range of threats on businesses. And then finally, the last T is too many, and there's just too many risks to insure them all commercially. I mean, we'd like to think we could, but we can't. And there's just too many policy exclusions in your commercial policies. I mean, COVID was a clear example of that. Businesses that were impacted by riots and had exclusions for riots. So their businesses were trashed, looted, destroyed, but because there was an exclusion for riots or vandalism, they didn't get coverage. So exclusions are very real, and they cause your insurance not to deliver when you really need it. And then this last one, I'm amazed how many times I've heard this just in the last 2 months talking to prospective owners of a captive, and that's that their commercial claims are denied or they're kind of bullied out of filing the claim. And I've talked to companies in Minnesota, in particular, Florida, and then in Texas that had a loss and the insurance refused to pay it, or there was an exclusion they didn't know about, or their broker said, look, you can't file that claim because you're just going to get, your rates are going to go way up, or you're going to get dropped and you won't have insurance at all. And so we're potentially entering into, a time where it may only make sense to insure the catastrophic business ending stuff, and everything else, say below 50,000, you just need to insure that through a captive. So let's pause right here and see if we have any questions. Okay, remember this is something that you can share with your clients. I'll be glad to send this to you. So why should businesses consider forming a captive insurance company? So let's talk about first what a captive is. A captive is a real insurance company that a business owner owns, just like they might own, another business. Think about just like starting a separate company, right? Except that it gets an insurance license, it insures their business, it insures related entities. So it's a very powerful strategy if you start to think about what that could do. I mean, think about very often businesses will form an LLC and own their property, or they may form a separate entity that holds their leased equipment, as an example. And so a captive is really nothing more than a vertically integrated supplier that's supplying a portion of your insurance, in some cases, all of your insurance. They have been around since the 50s, so they're not new. In the early days, they were used largely by the Fortune 500, Fortune 1000, but over time, more and more states are licensing captive insurance companies. Now, why do I say that? Well, insurance is really regulated by the states, not the federal government. And so states actually issue licenses to insurance companies. And as more and more states have licensed captives, it's made the cost to own a captive, to set up, to run a captive come down, which has made them really accessible to middle market companies, which is fantastic. And what do captives do? Well, first of all, they can replace commercial insurance. Not necessarily all of it, but in some cases they can. But they can help lower commercial insurance costs by taking on a portion of that commercial insurance. The second thing they can do is they can insure enterprise risks. And these are threats to the business. They're either operational inside the business or strategic outside the business that often the businesses are uninsured or underinsured for. And in many cases, these are the very things that will put you out of business, for lack of a better term, because they often choke off revenue. And that's really where the destruction comes. Captives can do really cool things like insure warranties. So many of your clients may be selling products and selling someone else's warranty when they could in fact be selling their own. And this is something that we've helped many clients do. And that turns your warranty program into found money, where businesses might be selling a warranty and getting a 10% commission, only to find out that there's only about a 10 or 20% loss rate, and that the backer of the warranty is really making all the money. And so once companies realize that, sell their own warranties, creates a completely new profit center. They can also issue performance bonds, which is particularly helpful in construction, for example, or say in coal mining or any kind of mining operation, any operation that requires bonds. Bonds are often money out the door with not much to show for it, except that you're allowed to do your job. So if you can insure those to your captive, it can be very powerful because that becomes found money as well. Captives can also insure employee benefits. And I've got on here healthcare. So a captive insurance program can help lower your health insurance cost by self-insuring a portion of that health insurance for employees. And many of our clients do this as well. And they typically save 15 to 20% on their healthcare program, which is fantastic. But you do, just so you know, you need to really have 50 employees or more to make that work. So be happy to share that with you as well. And then importantly, and I think this is particularly important for middle market businesses, is captives can really cover any combination of the above. So if you think about, say, an auto garage and you had multiple bays, if all you did was brakes, then you're not getting the most out of that garage. But if you do brakes in one of the garages, and the next garage over you do tires, the next garage over you do electrical, the next garage over is oil changes. By putting all that on the same roof, you really spread the cost of that that roof across all those different services. So for small mid-market companies in particular, it's very helpful to combine many of these things under one captive, because you're spreading the fixed cost of owning your own insurance company. All right, any questions so far? Feel free to unmute if you want to ask a question, or you can type it in the chat bar. Okay, very good. So here's a very simple captive insurance structure. We've got the shareholders on the top. They own their business on the left. There's a captive that they own on the right. They also have access to the profits in the business and the captive. So captives really do increase liquidity or cash flow for the business owner over time. And then you'll notice that the business pays premiums and transfers risk to the captive. The captive issues insurance policies back to the business. And so, if you're kind of thinking about captive insurance, where is the backstop, right? It's not as if if I have a big loss, is the captive going to have enough money to handle that loss? Well, captives are backstopped or reinsured, and there are lots of ways to achieve this. So when we talk about a captive, we're not really talking about, in most cases, a captive by itself. A captive is really a choice for a business owner to take a portion of their risk and then either share or transfer a portion of their risk. And that helps smooth out the impact of a big loss, right? So I'll show you some ways that we do that, just so you have an idea, and you can share this with your clients because they may be concerned about a captive and think it's too risky. So the first is what we call a traditional fronted reinsured captive structure. And so here what you'll notice is the shareholder owns the business. They also own the captive, which we've got over here to the right. And so they pay premiums and transfer risk to what we call a rated admitted fronting carrier. So this is a insurance carrier that states admit to write coverages that require being admitted, like, for example, work comp, right? Or auto liability, or property, if a bank requires rated insurance on their property. And then that rated admitted front is going to transfer premiums and risks to the captive owned by the shareholder. Now, in most cases, to do that, and you'll see here that the insurance policy is issued by the front, the captive issues reinsurance policy to the rated admitted front, but then the front is going to require, in most cases, that the captive be backstopped by a commercial reinsurer. And so very often these commercial reinsurers, the nice thing about the reinsurance market is it's in many ways, a wholesale market. So by having a captive insurance company with a license to write insurance, it's actually able to go out and access the commercial reinsurance market, or if you will, a wholesale market, which can help provide some cost savings in itself. But then by taking some of the risk in the captive, if the business owner can control that risk, they keep the profits in the captive from year to year. That's very powerful and allows them to start taking control of their own destiny. Now, in some cases, you don't need that fronting carrier. And so you'll notice here, just a straight up reinsured captive structure. We have a business or businesses that are writing premium check and transferring risk to the captive, which is issuing insurance policies back. And then that captive is simply being reinsured by a commercial reinsurer. So we've got a backstop that's going to pick up large losses. And once again, if the business owner can control the losses in the business, then this captive will accumulate money over the years, giving them more wealth, if you will, but also helping them smooth out the cost of insurance, especially the ups and downs of a hard market. And right now it's mostly up, by the way. Now we have a unique structure that we call a bundled captive structure, which achieves many of the same things, but it does it in a little bit different way. So you'll see here our shareholder or business owner, and they own their business. They also own their captive insurance company. And in this case, I've got the ownership dotted lines in. They're going to pay premiums and transfer risk to a commercial insurance company that has an A+ rating and is willing to match limits, terms, cost of their existing insurance, and then issue insurance policies to them. And then that commercial insurance company is willing to reinsure a portion of that risk to their captive. So in this structure, their captive's actually functioning like a reinsurance for part of the risk, normally what we call a lower layer of the risk, or maybe a quota share portion of the risk, where they're sharing some of the risk with the carrier, and then they issue a reinsurance policy back across all their different lines of coverage. And what this does is it allows the business owner to participate in their risk, try to control some of their insurance costs, and then build up those loss reserves in their captive insurance company. And then finally, and this is a structure we often use in some of our smaller captives for some of our smaller business owners. Remember, we're always looking for the backstop. We don't want to be left high and dry in the event of a big loss. Here we have, you'll notice the structure flipped around again. The shareholders own their business, and they also own their captive, and their captive is sharing risk in a pool of other captives, or you might think about this as a co-op structure, if you will, because it's very similar to co-oping, right? The thing about pooling that's different than reinsurance, so you notice here we're doing reinsurance, is when you pay premiums to a reinsurance carrier, they're gone. If you have a loss, they're on the hook for it. But if you don't have a loss, the money's gone. In a pool structure, once losses are settled up, the money flows back pro rata to the captives from the pool. And so that's a really nice structure in that regard. So let's think about a pool structure. And an example of an uninsured loss, let's say a $400,000 loss, the commercial insurance doesn't cover. What happens? The business loses $400,000. The wealth is destroyed. Maybe employees are laid off. But in a pool structure, we see that loss being addressed. So this business owner files a claim on their captive. Third-party administrator comes out, verifies it is a real loss. And in this structure, what I'm showing is basically a 50-50 sharing of risk. The captive pays $400,000 to the business after the claim is approved, and the pool pays $200,000 to the captive. So that really took a lot of the sting out of the loss, if you will. Okay. So preparing for trouble with a capital T, what happens to those assets in a captive that don't get paid out in claims or expenses? Well, the owner keeps all of it. And so what that does is allow the business owner or the business to accumulate reserves over time that can help prepare for the unexpected or trouble with a capital T. Any questions up to this point? Okay, very good. Let's keep going. So one of the exciting things about captives, and what I alluded to, is that captives are taxed quite differently than normal businesses. And if you think about, if you drive into most major cities and you look at most skylines, your banks, football stadiums, insurance companies are probably the three biggest buildings. And there's a reason for that. Insurance companies receive premiums, and then they really do loss reserve calculations, and they're able to loss reserve and not pay taxes on those reserves because they're holding them for future claims. And then they're able to invest and grow that money. So think about it. You can receive a lot of money, you cannot pay tax on it, and then you can invest and grow it. And then when claims occur, then you pay for the claims, right? And that really allows insurance companies to build up significant reserves. And that's one of the reasons that Warren Buffett made a lot of his fortune in Geico, as insurance companies are very profitable. Well, small insurance companies have an added benefit, if you will, that was created in 1986. So this is 35 years old. This is not new. And in 1986, in the Tax Reform Act of 86, they created what's known as the Tax Code Section 831B election. And so 831B is a tax election, and interestingly, large captives can be taxed under what's known as 831A. So it's not really creative, but 831B allows an insurance company to be taxed at a rate of 0% on their underwriting profit in the insurance company if the premiums received are 2.3 million or less on an annual basis. Now, this used to be 1.2 million, and the PATH Act of 2015 raised it to 2.2 million and tied it to inflation. So we've seen Congress standing behind this legislation, and I suspect it's because these captives really benefit these businesses and help them survive. And so, thinking about a captive preparing a business for trouble, now here's a great illustration. So we have two identical businesses over a 10-year period, and this business on the left takes $1 million a year, pays taxes, and puts it into retained earnings. They've got commercial insurance policies like you see here. The business on the right, everything else is the same. We have the same industry, same geography. Every single fact is the same, with one exception: they own their own insurance company. And the business on the right takes that same $1 million and buys insurance across all these lines of cover. So they may take part of the auto liability. They may pick up part of the employment practices. Work comp, they may take the deductible only, since that's very difficult to put in a captive for a mid-sized company. Very often we're able to pick up part of the property and general liability as well through the bundle program that I showed you. And then they insure all these risks that you see below that are real risks that the business faces, many of which were covered in the T's that we covered earlier, right? And so what you see here is that the business on the right actually has more insurance and more money. So they're able to, by owning their own insurance company, have more insurance and more money, which prepares them better for the trouble that could be ahead. And, you know, if we illustrate that out, and this is really what we call claims paying ability, or the ability to address trouble with a capital T, then you'll notice here we're showing a business owner buying insurance from their captive, $1 million a year for 10 years. And 10 years is not a fixed number. It's just for illustrative purposes. It can be 3, 5, 15, 30. And this column here is called informal self-insurance. And so here the business owner's paying taxes, accumulating the money as retained earnings. So we've got 5.9 million accumulated. Over here in the middle, we've got, instead of informal self-insurance, which means that essentially we're insuring the business out of savings or operations, we've got formal self-insurance, where we're insuring the business through a captive, and including the cost to run the captive, including some claims paid. You see how that bills to 10.7 million instead of 5.9. Now you will notice I've got a box here called a captive with hedging. Hedging is a proprietary strategy that we use when we work with business owners and their advisors that allows them to have a better exit down the road. You'll notice a little bit less cash accumulated, but if an insurance company is run well, it will generate profit over time, even if it has some bad years and pays out claims. And so down the road, we can turn those profits into long-term distributions for the business owner. So here you'll notice the same $1 million a year for 10 years buying insurance for the business and protecting it from trouble, allowing the money to grow for some amount of time, and then taking the money out over a 20-year period. Again, does it have to be 20 years? No, it's really just for illustrative purposes. So you'll see here that if we had no captive, that the business owner could take out $700,000 a year for 20 years. With a captive in the middle column and making the most expensive exit, and this is really paying a full capital gains tax, and then letting the money continue to grow and taking it all out, $900,000 a year for 20 years. So that's, considering all the extra insurance protection the business owner had, now having this much more wealth, it's a huge win, obviously. And then on the right, using a proprietary exit strategy that we can share with you in a more specific conversation, you'll see, and we call that a hedging strategy. You see the business owner can access as much as 1.4 million a year for 20 years. And the point isn't necessarily to convince you of one of these exits, but just to realize that this is the low end and this is the high end as best we know it. And there certainly are some exits in between. But nevertheless, the business owner, as we talked about here, the business owner is more prepared for trouble. So the captive insurance benefits and preparing for trouble, what are they? Well, a stronger business model as we think about all the risks that a business faces. Improved risk management via an insurance company. And what we've often seen is when businesses own a captive, they do a much better job of controlling their risks. They start to focus on those risks, they start to mitigate those risks and reduce those risks. Improved cost control, particularly when we start replacing commercial insurance in the captive, that can really help control cost. Keeping insurance profits and then rolling them over from year to year, which is very powerful. There is an asset protection component of a captive. A captive is separate from the parent business. And so it's very hard for somebody who is a creditor or someone who is suing the business to have standing against the insurance company. And so that can be very powerful. It allows for wealth accumulation via loss reserves. And then we talked about insurance company tax treatment. All of these 7 benefits are huge when you think about helping a business owner prepare for trouble with a capital T. And so really what it comes down to, if we really break it down into simple terms, when we think about trouble in River City, businesses that own a captive have both more insurance and more money at their disposal. And that is really the key to being ready for trouble. So what questions do y'all have of me? This is the end of our slides. I'll be glad to send these to you, and I'll be glad to answer any questions you might have. Okay, we've got one in the chat bar here. Very good. Is there a recording available? Yes, there will be. We are recording it, and we'll post it on our website and send it out to you. Good question. Very good. Well, if I can help you in any way, my phone number and email is right here on the screen. And if you would like these slides, just send me an email and I'll send them to you. And we'd be honored to have the opportunity to work with you, and hope that you have a powerful year, that you're able to really take care of your clients and help them navigate what looks to be a challenging year, and also potentially a challenging decade. Again, everybody have a wonderful afternoon.